When is the right time to invest? This video teaches you how to identify economic cycles and to invest at the right time. The financial market has gone through upheavals. Is your portfolio smart and safe enough? Micro specializes in economic cycle investing, and we're here to help you to invest responsibly. Assume that you have $1 million cash in hand and you are ready to invest. There are 3 ways for someone like you to start. First, buy stocks with all your money and hold them for a very long time. For example, the S&P 500 index. Second, the classic 60-40 rule. You invest 60% of your money in the stocks and 40% in treasuries to reduce risks. Third, economic cycle investing, which focuses on economic data and you can manage your portfolio based on market dynamics. If you have begun buying S&P 500 futures like Warren Buffett did in the 80s, you would have made 2,600% on returns throughout 40 years. However, do you recall the net bubble back in 2000? Your assets could shrink by 1,300% and the market would tumble again not long after that. During the financial crisis in 2008, a lot of investors couldn't take such pressure. Don't forget that investing is also a mental game. Very few of us were not confident enough to say that they could remain unaffected when caught up in a financial crisis. If you have applied the 60-40 rule on your portfolio, your rate of return reduces because exposures in the stocks were not high enough, and you need to compensate for the loss you made in the bond market. You could survive the net bubble and the financial crisis, but in the end, your returns would decrease by more than half. So apparently, it's not the most efficient way to invest your money either. What is economic cycle investing? It's an investing method whereby you can reduce or increase exposures in the financial market by observing the fundamentals and identifying economic cycles. It's high return, low risk. Before we dig in, you need to understand why the economy has cycles. The stock market is driven by human behavior. We like following successful people and their examples. We like to maximize profits and to buy at a low price. When everyone is buying, price goes up. When people start selling their stocks, price dips again, so the cycle repeats. You can find our economic cycle clock in Macro Global on our website. We divide the cycle into 4 phases: growth, slow growth, recession, and recovery. During the growth phase, GDP grows and corporate profits rise. The job market is also robust. Strong consumption eventually brings up inflation, and high inflation in turn affects consumption. When consumption slows, profits decrease. That's how our economy slips into recession. During recession, investment and consumption are weak. GDP contracts, inflation drops. The central bank cuts interest rates and implements quantitative easing to stimulate consumption and inflation, so the economy slowly gets on track to recovery. Employment improves as well. Each economic cycle is composed of 4 phases: growth, slow growth, recession, and recovery. In the next episode, we will show you how to observe and identify which phase the economy is in. Stocks, forex, bonds, and commodities, which financial asset is the better investment. So stay tuned.